I think this is a good time to talk about the UK economy to see where we are and where we might be headed, because there's lots of people at the moment who are interested in the economy, primarily politicians, because it is an election year. So an objective view to see where we are and where we might go could be useful. Now, what are we going to talk about? We'll talk about inflation, of course, but also UK growth, house prices, wage growth, whether it's a tight labour market, and also things like the UK stock market. So let's take a quick look through the UK economic data just to see where we stand. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and, of course, like this video. So let's start off with UK inflation, because a lot of the worries about the UK economy have been focused on that, and it impacts everybody's lives in a negative way. The most recent data showed a slight tick upwards, and it is slight, it's almost invisible if you look at a graph of UK CPI inflation, that's consumer price inflation. It ticked up from about 3.8% to 4%, and even the core measure, which strips out the volatile components, which is things like food, alcohol and tobacco, that also seemed to kind of flatline. So that was at 5.1%. Now, the sticky component of inflation in the UK and elsewhere is services, and that's a very large part of the UK economy. So if we break down UK inflation into two components, services, which is things like how much you pay a lawyer, how much you pay your hairdresser, and compare that with the price of goods, what's very clear is that goods inflation has come down a lot. So that's at about 1.9% currently, whereas if we look at services inflation, it's still very high, 6.4%. Now, the price of those services are driven by primarily wages of the people who provide the services, and those are still rising pretty sharply, too sharply, in fact, to be consistent with a 2% inflation rate. So the Bank of England is very keen on getting that rate of services inflation down, primarily through pushing down wage growth. And that is going to be a painful process, because what it usually means is that we have a recession, or at least a pickup in unemployment. Now, if we compare the UK with the other developed economies, what's pretty clear now is that inflation is falling such that we're roughly in the middle of the pack. We're above the US, so if we use a comparable measure, which is HICP inflation, US inflation is only about 2.1%. We're a little bit below France, which is at 4.1% inflation. We're at 4%. Germany's at 3.8%, and the EU average is about 3.1%. So pretty much in the middle of the pack now. So I think the outlook for inflation is a positive one, as long as wage inflation does start to come down. And the employment market in the UK is key to that. So if we look at nominal pay growth, that's not adjusted for inflation, the latest numbers suggest that pay growth is about 5% in the UK. That's for total pay, including bonuses. And the good news is that's above CPI inflation, which is 4%. So in real terms, wages are growing in the UK. Good news for people who are employees, not so good if you're the Bank of England and you're trying to get inflation under control. Although it's quite noticeable now that if you look at the rate of wage growth, it is falling very sharply, just like inflation is. So that will provide some comfort to our friends in the Monetary Policy Committee at the Bank of England. Furthermore, if we look at the tightness of the labour market, that's the number of available jobs relative to the number of people who are out of work, that ratio of vacancy to unemployed people, the VU ratio, has fallen very sharply. Currently it's at 0.64, it peaked at well over 1. And if we look at the UK unemployment rate, which is 4.3%, that has ticked upwards quite sharply, but from a very low level, in fact at multi-decade lows. Currently the unemployment rate is 4.3%. So it looks as if we've managed to get the labour market to be less tight without a huge pickup in unemployment. So perhaps, just perhaps, the UK will also be able to manufacture a soft landing. No crash in the economy in terms of growth and unemployment, while at the same time getting wage growth under control. So now let's turn to UK house price growth, because that's a subject which is a bit of an obsession here in the UK. And if we look at the year-on-year increase in house prices, the latest data from the Office for National Statistics shows that the prices are falling year on year. So the rate of growth is now minus 2.1%, And furthermore, that's accelerating downwards. The rate of fall is increasing. That's still not a huge rate of fall, but it is significant that it is accelerating downwards. That's hardly surprising, of course, given the number of people who are coming off their fixed period of borrowing for their mortgages. We're about halfway through the stock of fixed mortgages. 5 million people have come off their fixed rates since rates have shot up, and about 5 million people remain to come off their fixed rate mortgages. So the pain of higher rates is yet to be fully felt. And at the same time, we are seeing a softening of the labour market. So if people are more worried about their job security, they're less likely to make a big move and take on a much bigger mortgage, for example. And if we break down the house price changes by region, what's pretty clear is that regions where the price to income ratios were very high, in other words, you've taken on a house price which is very high relative to your income, those regions which are very highly priced have fallen the most, in particular London. But we are starting to see other regions like the Southwest, the Midlands, the East and the East Midlands start to fall pretty sharply too. Now, I still don't think there's going to be a house price catastrophe here in the UK because there is a limited supply and the economy is not too bad. So I think that'll probably start to slow down and this acceleration downwards will start to abate slightly. And that's because inflation will come down, the cost of borrowing will also start to fall, and we'll go back to something which is closer to normality, but clearly not zero interest rates. We're never going back to that. Now, if you do want to keep up to date with what's going on in the UK economy, as we're covering in this video, but also the global economy and markets and how the two interact, then you can do that by signing up for our weekly market roundup. It's free, it's delivered to your inbox on a Friday evening, as soon as we finish writing it, and it tries to be punchy and entertaining while being informative. So why not try it out for yourself? It's completely free, and you can learn how to do that by clicking on the link in the description below. Now, a really good indicator of the health of the UK economy is retail sales, because of course, if we're feeling flush, if we're feeling confident, we'll go out and buy stuff. So it was particularly worrying to see a collapse in retail sales in December. And that's true whether you look at the volume of sales, the number of things which were sold, as well as the value of things which were sold. Since inflation's been surging, what we've seen is a big divergence between those two numbers, volumes and value, with value increasing as volume fell. And that's because the cost of each unit of sales was increasing. However, clearly, what's happened recently is that higher prices are starting to bite into that volume and value of goods sold. Now, that's partly because, according to the ONS, people spent lots of money for their Christmas shopping earlier in the Black Friday sales. So they actually brought forward their spending and didn't have to spend so much in December. But what we're seeing is a fall in retail sales across the board. This is for food shopping, for clothes shopping, for a very wide variety of categories. And that's not good. There's no sugarcoating it. So until the economy does start to pick up, until we do start to see more confidence in the shoppers who are out there actually doing the shopping, then I don't think we'll see retail sales really start to pick up again. But if we do see inflation falling and we see unemployment not rise too much, then that could be the turning point for retail sales. Now, if we put everything together, what we get is gross domestic product. So that's the total amount of goods and services produced in the UK. And that's why it's a useful aggregate measure to measure the health of the UK economy. And for this, the UK is looking pretty weak. The Bank of England expects a pretty flat GDP level for the next 2 or 3 years. And we do seem to be tracking along at that zero rate of growth at the moment. In fact, there's very little sign of growth since March of 2022, after we got the pandemic rebound. Now, what we can do is compare our rate of growth with other countries. So, for example, if we compare our level of GDP with the US, what's pretty clear is we didn't really bounce back as much as the US. Furthermore, growth has now stalled in the UK, whereas in the US it's kind of storming upwards. So, not a great comparison. And the UK looks pretty weak compared to the US. But perhaps that's not a good comparison. What we should be comparing ourselves with are other European countries. And there we don't look so bad. So it's not a matter of comfort, of course, but if we look at German growth, that's actually lower than UK growth. And there have been a number of problems in the German economy this year. They've seen very widespread strikes, and they've seen their exports start to suffer as well. And in fact, if we look at Europe in general, the growth forecasts are looking quite weak. And this is something that the IMF has pointed out, amongst others. So perhaps this is more of a European thing and not so much a UK thing, having this period of weak growth, as higher prices are starting to weigh on economic activity. At a certain point, your savings run out and you're going to have to tighten your belt. And then finally, turning something which is close to my own heart, because I've recently bought some UK stocks, we'll look at the UK stock market. And in this case, if we look at valuations in the UK, it seems to be pricing a bit of a catastrophe, certainly a deep recession. And yet that's not what we're seeing in the UK. We're just seeing sort of pallid, weak growth rather than a full-blown crisis. But UK stocks are trading at a 10 times forward multiple. And that's not as bad as we were just after the global financial crisis, but it's not much better. And in fact, we've been bouncing around at low valuations for a while now. Now, it's not the case that the UK never re-rates upwards. If you look at 2000, for example, UK multiples were looking really good at that time. So I think this is a market which is unduly beaten up. If you compare us to the rest of Europe, the growth is okay, the inflation is okay. Maybe there's more political uncertainty given that we've got an election coming up and it's not clear who's going to be in charge. It's also not clear that current policies are particularly growth friendly. But the UK market, I think, is looking unduly cheap. And this is one of the reasons why I've bought a portfolio of UK value, quality, momentum stocks. It's a combination of three factors. So in summary then, I don't really think that the UK is in a full-blown crisis, and yet many of the assets in the UK are pricing in something like a crisis. We're probably well past the peak of inflation, and the Bank of England is winning its fight against inflation, which is very comforting to see. Even sticky services prices, that sticky component of inflation, should start to come down once we do see wages abate, which is what we're seeing. So personally, I think that the UK will start to turn the corner slightly in terms of growth, and I think that our assets are underpriced. Now don't forget, if you want to keep track of the UK economy, the global economy and markets, and how the two interact, you can do that by signing up for our weekly market roundup. And there's a link in our description which shows you how to do that. And, as always, thank you for listening.